What do you focus on? What you're seeing in TNSE?
Yeah, I mean, we're solving for yield, right? So we work with accredited non-institutional investors. So initially started the company to help a problem that our family office had, which was accessing good quality direct co-investments that were targeting double-digit yields on a deal-by-deal basis, but that didn't have LPs that were non-taxable, right? So what we found was often a lot of the sponsors or fund managers we were working with had big endowments or institutional non-taxable LPs that were really driving the investment decision-making process in a tax inefficient manner for the other equity holders that were taxable entities. So we created this platform for initially the family, and then it became friends and family. And now we have a really broad network of investors, but we still try to solve for those three pain points. And we still try to work with just that discrete population set. So right now, frankly, in Nashville, my cost of capital, in other words, my yield that I'm trying to achieve to my investors that we send out in monthly distributions, is not possible to achieve today in Nashville. It's become an institutional marketplace. Cap rates are ridiculous. I think it makes a ton of sense to develop in today's market here locally. But if you're trying to buy core plus, value add, forget core, you're going to be paying a very high price point. And, as my mentor has told me over the years, the three most important words in commercial real estate investing are basis, basis, and basis. And so when you go in with that price per pound, you're married to it for the rest of your investment horizon. And it's just not something that we can accomplish given our investment strategy.
Brian, it's an interesting perspective that you shared on the institutional partners that you had. I haven't heard that before, and I've heard a lot. That one of the reasons for their cost of capital being so low, I try and connect the dots to what you just said, their cost of capital being so low, and therefore their ability to pay up for assets, or making an assumption, is because their capital is non-taxable. Is that right? That they are when they're underwriting to the bottom line, they're underwriting in a different way because of taxes than individual investors or other private equity sources might have. Can you just elaborate on that a little? It's an interesting observation.
Sure. I think that's part of the equation, right? Is if you're not a taxable entity, then tax efficiency or after tax returns, net of fees, only part of that equation relates to, right? So for instance, I get asked a lot, like what the definition of a family office is. And so for me, it's a corpus of assets meant to maintain a quality of life across a multiple generation time horizon. Now, when you think about kind of high net worth individuals or families, and you talk about asset allocation or return profile or expectations, it's really simple math, right? You've got inflation, and let's call it 3%, even though we've been seeing 7 kind of, and we can talk about inflation if you want, but let's peg it at 3%. And then you've got your spend rate, or maintaining your quality of life. Let's call that a 4% overhead spend rate, plus the exponential growth of your family. You put that all together, you probably need to be hitting annual 10% plus returns to maintain that quality of life over multiple time horizon generations. But importantly, when you're making these investment decisions as a family, you're looking at net of fees after tax returns, right? Because taxes and inflation will kill you over the long term when you're dealing with a kind of corpus of assets that the principal is not going to change dramatically. Whereas if you are an institutional investor and you're non-taxable and you're trying to solve for a 3 or 4% return, that's a different mindset, right? And that's a different investment strategy and thesis. And that's what we've been seeing play out over this last, call it since the Great Recession, this search for yield, this liquidity in the marketplace. At first, it was driving institutional investors, especially international, to come to domestic US, which then meant the private equity groups had to go lower. And then it's now trickling all the way down to fundless sponsors like myself.